Equity market update, January 2023. Indian equities declined during the month, primarily driven by international research report released against a large domestic conglomerate. Nifty 50 and S&P BSE Sensex ended the month with negative return of about 2 to 2.5%. Large FPI selling also resulted in equity indices declining. Large caps marginally outperformed the mid caps and small caps. Amongst the sectors, performance was mixed. Auto, IT, metal and capital goods outperformed, while power, oil and gas and banking underperformed. Key developments during the month included Bank of Japan maintaining its policy rate, China witnessing a strong reopening post-relaxation of COVID-related restrictions, IMF revised its global growth forecast from 2.7% to 2.9%, but World Bank revised down its global growth forecast from 3% to 1.7% for CY23. Most major global equity indices gained month-on-month as market factoring in most central banks close to their peak rates. Further, growth impetus likely because of China reopening also supported the market. FPI sold equities worth $3.7 billion and has cumulatively sold equities worth $5.6 billion in FYTD23. On the other hand, DIIs bought net equity worth $4 billion in January 2023 and have cumulatively bought approximately $26 billion in 10 months FY23. Net inflows to mutual funds in December 2022 inched up to approximately INR 15,400 crore and INR 1,67,000 crore in 9 months FY23. Of the Q3 FY23 results, earnings of banks, NBFCs, auto, industrials and IT were better than expected, while that of cement, metal, oil and gas and consumer staples were largely in line with expectations. Results of consumer durables and pharmaceutical were lower than expectations. Outlook: as on 31st January 2023, Nifty 50 was trading at approximately 19x FY24E and 16.5x FY25E price to earnings ratio. While the valuation multiples are high compared to its historical average, it should be viewed in context of a robust economic recovery and healthy corporate earnings outlook. The ratio of India's market cap to GDP based on CY23 eGDP is relatively high at around 88%. But of its recent peak, the gap between 10-year GSEC and 1-year forward Nifty 50 earning yield is also higher than its long-term average but off its peak. Again, corporate earnings growth is likely to normalize from FY24 onwards and should move in line with nominal GDP growth. Overall, the markets appear to be reasonably valued. The valuations for major sectors are close to or higher than long-term averages. In view of the above, while markets hold promise over the medium to long term, one should moderate return expectations in the near term. Outlook for the market is likely to be driven by expected growth in nominal GDP and corporate earnings growth. Optimistic domestic growth outlook, steady corporate profitability, growth supportive policies, improving rural demands, etc. bode well for the economy and equity markets over the medium to long term. Higher than expected monetary policy tightening by global central banks, especially US, sharp increase in US yields, sustained elevated inflation, continued FPI's outflows, escalation of geopolitical issues, etc. are key near-term risks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.